currency wars and the death of money. Now, in this segment, I first asked him all about Russia and oil, and here's what he had to say.
I agree completely, and of course we talked a little bit about that, a few minutes ago about how some of these, Russian corporate bonds could end up in U.S. 401ks, but it's a lot more complicated than that. First of all, it's not all about Russia. I mean, there are a lot of emerging markets that have borrowed in dollars that don't even make as many dollars as Russia. At least Russia has some capacity to earn dollars to pay off dollar debt, and they have a pretty good reserve position. But I look at places like Turkey, Mexico, South Africa, Brazil. They have enormous U.S. dollar debts, and not clear that the corporations, at least, have the U.S. dollar earnings or access to reserves to pay them off. And so they may go, some of those companies may go bankrupt. The problem, Aaron, is you're looking at about $9 trillion of U.S. dollar-denominated emerging market debt. $9 trillion. It's not all going to go bankrupt, but let's just say 20% went bankrupt, or even, let's just say 20%. That's $1.8 trillion of losses. That's twice as big as subprime in 2007. If you look at subprime plus what they call Alt-A, Alt-A is just a mortgage kind of like subprime. The amount of subprime in Alt-A in mid-2008 was about $1 trillion. Well, if you have $9 trillion of emerging market dollars-denominated debt, and you write it off 20%, that's $1.8 trillion of losses. That's 5 times what happened in the mortgage market. I mean, mortgage losses weren't 100%. So it's 5 times bigger than what happened in the mortgage market in 08. So there's contagion for you.
Now, a lot of people are talking about the Ruble rout as a crisis along the lines of 1998 or 2008. So do you think this is what we're seeing right now, Jim?
Well, I think it's similar in the dynamic, but of course it's never the same in details. There were a lot of differences between Russia today and Russia in 1998. The problem in 1998, Russia had an enormous amount of U.S. dollar-denominated debt, government debt, external debt. And you had banks like Credit Suisse that were out there sort of writing derivatives on it, multiplying it. I'll go back to my experience at long-term capital management. A lot of people say, oh, long-term capital management failed because Russia defaulted. Well, that's not exactly right. We only lost $100 million on Russia. We lost $4 billion overall. The losses at long-term capital management were $4 billion in about 6 weeks. But only $100 million of that, a relatively small portion, was Russian debt. But what happened was the Russian default caused a global liquidity crisis, and that caused everyone to sell everything. So at long-term capital management, we lost money on, German swap spreads, French swap spreads, Japanese swaps. We lost money all over the world. We didn't lose that much on Russia, but Russia was the first domino that started all the other dominoes falling. So now Russia's in a very different position. They do not have as much external dollar debt relative to the reserves. The reserve position is fairly strong, including about $50 billion of gold. Let's not forget that Russia has been a major, major gold buyer, and that gold is a very solid asset on their balance sheet. So there's not going to be a big external sovereign default in Russia. Russia has enough reserves to pay off its sovereign debt. The problem is elsewhere, corporate debt. European banks that may own it, U.S. investors who may own it decide to sell, and then margin calls coming in. I mean, there's a lot of things that can ripple around the system. So we certainly haven't heard the last of this.
Now, Jim, you've been talking about the U.S. dollar as having problems, but everyone else is talking about a strong dollar, and they say that the strength of the U.S. economy is strengthening the dollar and creating volatility elsewhere. So what's your view?
Well, a couple of things. First of all, the dollar is very strong. It's the strongest it's been in about 8 years. So that's just objective data. There's no question about it. But let's think that through. The Fed says they want inflation. That's not me making it up. The Fed has said they have a 2% inflation target. In fact, in December 2012, they said they were not going to raise rates until not before a forward forecast indicated 2.5% inflation. And again, I've spoken to Fed officials privately who have told me they wouldn't mind seeing 3% inflation. So let's just say the Fed has an inflation goal of 2 to 3%. Right now, inflation is about 0, even slightly negative. A strong dollar is deflationary, so it's the exact opposite of what the Fed says they want. So, and the Fed's been sort of hinting that they may raise interest rates in 2015. Well, that makes the dollar even stronger. So now you've got this conundrum. The Fed wants inflation, but they have a strong dollar. They're going to raise rates, make it stronger, which causes deflation. It's the opposite of what they want. So the only way that all makes sense is if the U.S. economy is really strong, but the U.S. economy is much weaker than meets the eye. These GDP reports, a lot of that was inventory. There was some, Commerce Department failed to make some seasonal adjustments in the third quarter. There's a lot there, a lot of reason to believe that those numbers are going to be revised down, and that the fourth quarter and first quarter of 2015 are going to be a lot weaker. So now the Fed may be in a position where they can't raise rates because the U.S. economy is weak, and then this whole thing may reverse. But for the time being, but by the way, Aaron, Bernanke gave a very important speech in Tokyo in October 2012, and Janet Yellen has echoed this since then. They say, hey, we're the U.S. central bank. Our job is to take care of the U.S. economy. You emerging markets are on your own. Sorry, it doesn't work that way. You know, we're in a globalized world. You can't be globalized on the way up and then somehow separated on the way down. If this strong dollar causes the emerging markets crises of the kind I'm describing, and it does start to resemble 1997, 1998, all these chickens are going to come home to roost back in the U.S., so the Fed's not going to be able to wash their hands of it.
That was Jim Rickards, Chief Global Strategist at West Shore Fund and the author of The Death of Money. Time now for a very quick break, but stick around because when we return, we're going to share with you the best comments from our recent guests in today's Defining Moment segment. And in today's Big Deal, Ed and I are discussing some of the biggest deals of 2014, from falling oil prices to the bond bull market.